welcome back. Now let's continue from where we stopped. Now we are taking part two of this topic, international tax policy. Now we will be looking at taxation of inward and outward investments. Now, what do you understand by inward investments? What do you understand by the word inward investment? An inward investment, which is the opposite of an outward investment, involves an external or foreign entity either investing in or purchasing the goods of a local economy. Inward investment, you are investing in local what in the goods of a local economy, or you are purchasing the goods of a local economy. So it is a common type of sorry inward investment is what is a common type of foreign direct investment. Okay, so it is a common type of foreign direct investment. Are we together? So whereby individuals or citizens of a particular country investing or purchasing goods of the other of another country. Okay, are we together? Okay, so this occurs when one company purchases another business or establishes new operations for an existing business in a country different than the one of its origin. Is that clear? So inward investment uh, or foreign direct investment often results in a significant number of mergers and acquisitions rather than creating new businesses. Inward investment often occur when a foreign company acquires or merges. When they acquires or what or merge with an existing company. Foreign direct investment or inward investment occur when a foreign company acquires or merges with an existing local company. So inward investments tend to help companies grow and can open borders for international integration. Now let's take outward investments. Outward investments implies that now let's discuss it this way. There's growing evidence that outward foreign direct investments can increase a country's investment competitiveness, crucial for long time suitable growth. And it happens thus it is a situation whereby countries, okay, whereby countries are inviting, okay, countries are their citizens, okay, their individual citizens, or their in local companies, okay, their local companies are promoted, and they are exports, okay, they are being sold out to individuals, or they are being used by companies in another country. Are we together? So that was outward investment. They are producing, okay, for the purpose of other companies in other country or in other jurisdiction. Are we together? So instead of inviting the foreigners to their country to come and be producing that material or that specific goods, they themselves, they are producing the goods for the purpose of what? For the purpose of sale to other countries for use in other countries. So some countries are thus using outward foreign direct investments as a channel for new development and a catch-up strategy to acquire knowledge and technology, upgrade production processes, boost competitiveness, augment managerial skills, and access distribution networks. Countries use foreign direct investments to what? To acquire knowledge, okay, and technology, upgrade production processes, upgrade production processes, boost competitiveness, boost competitiveness, okay, and also augment managerial skills, and also access, okay, access distribution what? Distribution networks, okay, access distribution networks. So an outward direct investment is a business strategy in which a domestic firm expands its operations to a foreign country. I repeat, an outward direct investment is a business strategy in which a domestic firm expands its operations to a foreign country. This can take form as a greenfield investment, a merger acquisition, or expansion of an existing foreign facility. So employing outward direct investment is a natural progression for firms if their domestic market becomes saturated and better business opportunities are available abroad. That is, they have satisfied their local markets. They have satisfied their domestic market, and it therefore becomes necessary to go out of the country to extend their business to foreign countries, to expand, okay, and so as to maximize their income and boost or promote the gross domestic product of the economy. Okay, so the extent of a nation's outward direct investment can be seen as an indication that its economy is mature. Take for instance, American, European, and Japanese firms have long made extensive investments outside their domestic market. Isn't true? Isn't true? Yes, it is, because now you like Rolls Royce, you like Mercedes, you like BMW, you like now if we are talking of machinery, you'll be talking of Japan products, isn't it? Or Germany products, isn't it? So, and each category of products has this country specific that they are known of high quality. So because of their more rapid growth rates, emerging market economies often receive large amounts of outward direct investment. Take for instance China, brother, sister, dear colleague, I know most of the instances or the most of your households are from China. Yes or no? Yes, except in a rare situation. So as China has for the past 2 decades, okay, there is a rapid growth in their market economy. But even some emerging market countries have begun to make investment abroad. Okay, yes, they have begun to make investments abroad. So Chinese companies are now engaged in what they are now engaged in large scale. Okay, Chinese company Chinese company or companies, okay, are now engaged in what? In larger They are now engaged in large scale outward direct investment. Yes or yes? Yes, that is obvious, and that's a good example to illustrate. So in 2015, not far back, Chinese overseas investment exceeded foreign direct investment. Yes, Chinese investments in other countries exceeds their foreign direct investment. That is, it exceeds the inward direct investment or inward investment. So it exceeds the inward investment in China for the first time ever. While in 2016, Chinese companies invested over 170 billion overseas. They invested 170 billion overseas, that is in foreign countries, look at this huge investment. Okay, so virtually all governments are keen to attract foreign direct investments. It can generate new jobs, bring in new technologies, and more generally promote growth and employment. And the resulting net increase in domestic income is shared with government through taxation of wages and profits of foreign-owned companies, and possibly other taxes on business, such as property tax. Okay, so you can see the advantage of this, inviting foreigners to come to our country to invest. It boosts our economy, and not alone that it boosts the economy, it's also what it also help government increase their revenue income, their revenue generation. Is that clear? So foreign direct investment may also positively affect domestic income through what? Through spillover effect. Through spillover effect, such as the introduction of new technologies and the enhancement of human capital skills. Okay, now you can imagine the modern railway line. This Chinese company are doing for us now in Nigeria, from Lagos to Ibadan. Now you can imagine at the completion of this project, how transportation uh, by rail will be much more, uh, one, it will be faster than before, and also cheaper than before. Yes, and also imagine the modern facilities that are used in achieving this. So it increases what it introduces new technologies and enhance human capital skills. So given these potential benefits, policymakers continually re-examine their tax rules to ensure they are attractive to inbound investments. Are we together? So tax policies may support direct investment abroad, as outbound investment may provide efficient access to foreign markets and production scale economies, leading to increased net domestic income. So as we invite the foreigners to invest through foreign direct investments, you also, as a country, you should as well put more effort in investing in other countries, so as to serve as what? To serve as outward direct investment. Okay, so to a layman, foreign direct investment or inward investment is inviting foreigners, foreign companies, make making them investing in your country, in our home country. Take Nigeria as a case study, and then and Nigeria should also be encouraged in investing abroad. So that's outward, inward. My talking sense. Okay, thank you for being with me, and thank you for your cooperation. Mind you, tax competition for foreign direct investments. Okay, tax competition for foreign direct investment is a reality in today's global environment. Is a reality in today's global environment. So at the same time, governments continually balance the desire to offer a competitive tax environment for foreign direct investments with the need to ensure that an appropriate share of domestic an appropriate share of what an appropriate share of domestic tax is collected from multinationals. So uh but white tax is recognized as being an important factor in decisions on whether to invest or where to invest. Okay, it is not the main determinant. Okay, it is not the main determinant. Are we together? It is not the main determinant. Is that clear? So, Federal foreign direct investment, okay, is what is attracted to countries offering offering access to markets, offering access to markets, offering access to markets and profit opportunities, and also a predictable and non-discriminatory, sorry, offering access to markets and profit opportunities, okay, and also a predictable and then non-discriminatory non-discriminatory legal and regulatory regulatory framework, okay, and macroeconomic stability. Among others, we also have our skilled and responsive labor markets, and also well-developed infrastructure. Okay, all of these factors will influence the long-term profitability of a project. Okay, so all of these factors, skilled and responsive labor markets, well-developed infrastructure. Okay, so you can imagine a particular foreign company is about to establish it or invest in Nigerian company, and they find out that those charged with governance in this company are what they are unskilled. Okay, they are less skilled. So how would they manage the company effectively? There is no idea. There is nothing. Okay, so or there's no well developed infrastructure in place. There's no electricity and the likes. Okay, sorry. So all these should be in place so as to, because they will influence the long-term profitability of a project. So tax competition for foreign direct investments is a reality in today's global environment. So investors routinely compare tax burden in different locations, as do policymakers, with comparisons typically made across countries that are similar in terms of location and market size. Exactly, like the example of Starry I did in part one. Uh, America or England is taking 20% and Nigeria is taking 30%. So if you are in Starry position, what do you do? So will you pay to Nigeria at 30%, or you prefer paying to England at 20%? So a widely held view is that taxes are likely to matter more in choosing an investment location as non-tax barriers are removed and as national economies converge. Is that clear? Okay, so there is broad recognition that international tax competition is increasing, and that what may have been regarded as a competitive tax burden on business in a given host country at one point in time may no longer be so after rounds of tax rate reductions in other countries. Are we together? After what? After rounds of tax rate reductions in other countries. Is that clear? However, it is not always clear that a reduction it is not always clear that a reduction is required or is able to attract foreign direct investment. So where a higher corporate tax, okay, where a higher corporate tax burden is matched well developed infrastructure, public services and other host country attributes at attractive to business. Okay, so where a higher corporate tax burden is matched by well developed infrastructure, public services and other host country attributes attractive to business, including market size, tax competition from from relatively low tax countries not offering similar advantages may not seriously affect location choice, isn't it? Because they have low tax rates. Okay, so instead of investing in a country with 30%, you rather prefer to invest in a country with what, with 20% income tax. So because they are not what, they are not offering similar advantages, and in this case this will not affect what, it will not affect location choice. Okay, so though Nigeria may be giving some other tax incentives that this country likely not to give, but this will not affect what, location choice. It might affect some other choices. Okay, so indeed a number of large OECD countries, organizational for economic cooperation and development countries with relatively high effective tax rates, are very successful in attracting foreign direct investment (FDI). This points to the importance of market size and other host country attributes in attracting FDI, and the presence of location-specific profits that governments are able to tax. So it is also clear that a low tax burden cannot compensate for what? For a generally weak or unattractive foreign direct investment environment. Yes or yes? Yes. Yes, because it is what, there is what, there is an unattractive but foreign direct investment, or it is weak. So it's that's having a low tax rate will not be sufficient, or it will not compensate or will not make foreign direct investments attractive. So tax is what? Tax is but one element and cannot compensate for what? For poor infrastructure. It can't. So, and it also cannot compensate for limited access to market, and also other weak investment conditions. So also, while attention often focuses on corporate income tax, the importance of other taxes must be recognized, such as what? Energy taxes, payroll taxes, and non-profit related business taxes are increasingly under the what? Under the spotlight by investors and policymakers. Yes, they need to consider them as well. Okay, so they need to consider all other what? All other taxes, and not only what? Not only corporate income tax, because all these also contribute to what? To attracting foreign direct in investments. Are we together? So another factor is how business friendly the tax administration is perceived. So is the tax administration in your country business friendly? Okay, so it is how they are perceived to be. So investors look for certainty, predictability, consistency, timeliness in the application of tax rules, and in many cases these considerations are as important as the effective tax rates paid. And that's why the general tax principles as what? Certainty, simplicity, consistency, efficiency, and the likes. So the tax environment will also what? Will also be influenced by the need what? By the need of government to introduce what? To introduce anti-abuse measures. To introduce what? To introduce anti-abuse measures to protect the tax system from what? From sophisticated tax what? Tax planning, or aggressive tax planning, or tax schemes, okay, which exploit differences across what? Across tax systems. So a key challenge is striking a balance in devising rules to adequately protect the tax base. Striking a balance in devising what? In devising rules to adequately protect the tax base. Okay, so devising what? Devising rules to adequately protect the tax base. So without imposing what? Without imposing excessive compliance cost. Without imposing what? Without imposing excessive compliance cost. So for individuals or businesses to comply, so hope the cost of complying is not even much more than the cost of non-compliance. So In doing so, it can be difficult to accurately weigh business arguments that foreign direct investment will locate elsewhere unless the scope of the tax-based protection measures is reduced. So you should also reduce the scope of your anti-abuse measures so that the cost of compliance will not be much more than the cost of non-complying. So it is the cost of non-compliance that should be more than the cost of compliance. Are we together? Okay, so we are progressing, right? Now we shall take a break here, and when we come back, we continue from where we stop. And next is part 3 of chapter 1. Goodbye.